Welcome to the final presentation for the BSG for the Jazzy dogs. This is for Texas A&M Corpus Christi, Management 5355, the business strategy game. We were Industry 1, our team letter was J, and we named ourselves the Jazzy Dogs. And this project was co-managed by myself, Sandy Crutcher, Eric Lugo, and Don Yancey. What we're going to do today is just review the statistics of the outcomes related to the different areas of the project with you. So where I'm going to start is with our strategic vision. The Jazzy Dog strategic vision was to create the perfect shoe for all mankind, made from the highest quality materials, while maintaining our focus on environmental and worker-friendly initiatives. The only resource we value more than our shoe are our people. So while we wanted to focus on creating the largest return we could, increasing our revenue, and having a great quality shoe, we also wanted to give back and make sure we were a good place to work for our employees. And we did that by investing in our overall compensation plans. When you look at the base pay, the ratio of supervisor to worker, and a lot of the fringe benefits, we were above average in that area for that industry. And interestingly enough, in the North American facility, it did make our productivity levels higher than the industry average. Strangely enough, the Asian Pacific facility wasn't as high as the industry average, but it's still a great place to work, even if we didn't get the productivity we expected in that market. So I'm going to take you through where we started, a strategic group map for the North American wholesale segment, year 11. And you can see, J, we're up there on the right-hand corner. It's a good place to start, right? We want it to be a high-quality shoe, made from high-quality materials. I don't want to say a Louis Vuitton, but maybe a high-priced Nike shoe is really what we were aiming for. We had a competitive strategy of broad differentiation, and we added several styles and increased quality materials to kind of set us apart from our competitors. And you can see here we're really far set apart from everyone. Another thing we did was we wanted to take advantage of the lower interest rates with the high credit you start with. So we borrowed funds initially in the beginning while we had that high quality rate. Now, of course, our strategy was to keep that high quality score, but you never know how that's going to go. So we did consciously borrow money in the beginning to take advantage of that lower interest rate. And you can see here our SQ rating was also high because we invested highly in Six Sigma and other programs to keep our reject levels lower so we could produce more quality shoes that actually make it to the market. Now, when we move to the end of the project, to year 17, you can see we drop a bit here. Our largest competitors were L and H, and we'll dive more into that later. What happened here is we got into some areas of trouble. One thing we noticed initially, the exchange rates weren't very favorable, depending on where you were shipping some of your inventory, so we had to adjust that. But I'd say the biggest challenge we had was at some point we noticed we had a surplus of shoes, right? So we had done a great job producing shoes, but we had too many, right? We had to move those shoes. So we did have to go in and tweak where we were putting our funds to invest in areas that would allow us to sell more shoes. So for example, our internet advertising, we increased that. We also did more retailer support, put money there. Initially, we had some celebrity spokesperson, but then we had trouble trying to get those back. We seem to be outbid on those a lot. So we invested in more private label contracts as well. So you can see here we dropped a bit. I would say we probably ended up at average area. So we weren't the best, but we also weren't the lowest. But we were still maintained a solid presence and became a solid stock, which you'll see in my next few slides here. So when we look at net revenue trends, you can see overall it's a positive story. As I mentioned before, the private label, we didn't always get those contracts. So in year 11 and year 16, you can see where we dip a little bit there. And that directly correlates to those years where we didn't get those contracts. You can also see here where we did put the money in, additional money, in the internet advertising, the search engine advertising. And it's a steady incline there, increase there, which together with our private label options and all the other areas here made our total pretty high at the end. So ultimately, it's a positive story. I mean, we had some years that were a little bit of a struggle, but we were able to sell our way out. If not be number one, but we did, if you look here, start, over twice, earn over twice where we started. So we started with 400,000 and we end at over 900,000. So it's a pretty positive story there. Our earnings per share trend pretty much mimics our net revenue trend. You can see where it fluctuates a little bit in those same years, but ultimately we increase. And this is due to us investing in areas where we could sell more shoes, right? Because we were having issues with all that overage of shoes. In the areas where it fluctuates a little bit, it can be said also related to where we didn't have a celebrity spokesperson, and we had to invest more in advertising as well as supporting our retailers to try to get those shoes out the door. Overall, I'd say we were a good stock. We had a solid return because you can see we started with $2 there and we end at 3 times that amount of $6. When we look at stock price trends, it's a little bit more of a volatile story. So in here you can see we dip a little bit again related to the private label issues. So year 11, you can see we didn't get any private label contracts, and also I believe it was year 16 where it drops a bit as well. We had to go back and try to change our strategy. So initially we wanted to be a high quality shoe, and to try to sell our way out. We know we can lower the price of the shoe, but we didn't want to do that. We didn't want to affect our bottom line negatively in that way. So we kept our price high, knowing we were going to have to invest more to sell more. So instead we made cuts to some areas where we could to try to help, the stock price. So we did end up lowering a little bit of the quality materials, how much we were investing in that, which did affect a little bit of our credit rating there. But overall, we finished strong, and we did, I think, a pretty good job. So I'm going to turn the presentation over to my co-manager, Don Yancey, now, as we enter the competitive analysis slides. Thank you.
Hello, my name is Don Yancey, and I'll be doing the competitor analysis. The team that we regarded as our closest competitor was Team H, Happy Souls. In year 11, they started with a price of $80 in North America, $85 in Europe, Africa, $80 in Asia Pacific, and $85 in Latin America. The price for their shoes were mid-range among all the competitors. They also had an average SQ rating for all the markets as well. Their beginning market share for internet sales was between 11.8% and 12.7% for all 4 markets. Wholesale market share was between 6.6% to 10.5% for all those as well. For years 11 and 12, Team H did not pursue private label, but this was corrected the following year. After year 11, we were not yet too close. We were separated, but it was at the end of year 13 when they did their strategy change that they came close, really close to us. In fact, in Asia, they were exactly the same place we were. All the other markets were pretty close. This is when we started considering them our competitor and kept an eye on them. Their strategy was to increase quality, advertising, and their image rating to retain a good market share. They also managed, after year 13, to keep up a good celebrity appeal, which helped them to reach an image rating of 100 in years 16 and 17. As they gained in popularity, they started to expand their models from 396 to 500. They ended year 17 between 13 and 15.4% for internet sales in all 4 markets, between 14 and 16.2% for all markets in the wholesale segment, and between 15.8 and 16.2% for the private label segment in all 4 areas. As their SQ rating increased, their wholesale price increased as well. Even with price increases, they stayed below the industry average. The demand for Happy Souls increased in line with their brand reputation. Happy Souls started the year for year 11 with net revenues of $513,340,000, earnings per share of $182, ROE of 15.9%, and a stock price of $19.84, and also a credit rating of A-. By year 17, net revenues grew to $1,747,141,000. Earnings per share dropped slightly to $19.43. ROE raised to 37.4%, and their stock price was a whopping $518.50. They also had an A+ credit rating. TMH was an effective competitor. They left us behind. They made better decisions than we did, and we tried different strategies that ended up in them pulling further away from us. While we started off close, the end speaks for itself. Their strategy changes in year 13 really helped them to get a good chunk of market share. They also made good decisions in marketing, also in their quality, and like I said, we regard them as a competitor because we were keeping an eye on them and trying to make better decisions to beat them. We just couldn't pull it off.
Thank you, Don. As mentioned, the closest competitors to Jazzy Dogs was Happy Souls. I will be discussing Happy Souls' competitive strategy and what Jazzy Dogs can do to improve in the next 2 to 3 years. When we started in year 11, our company's strategy was a broad differentiation strategy, just like our closest competitor, Happy Souls. We offered a high-end shoe that was high quality, as Sandy mentioned earlier. Our strategy looked equal to its competitors with some slight differences. Over the years, Happy Souls increased their style and quality ratings, while we changed strategies to cut costs and lowered our style and quality ratings. This, I believe, affected our demand, and our consumers year over year were not happy. From year 11 through year 17, Happy Souls maintained and offered a lower cost shoe compared to our company. Since our strategy was to offer a higher quality shoe, we anticipated the consumers would not mind paying a premium for our shoe. Happy Soul's strategy to offer a like kind quality shoe at a lower price gave them the advantage over us. Happy Souls increased the model available from year 11 to year 17 to appeal to the consumers, while Jazzy Dogs really did not make any significant change, mainly due to our cost-saving strategy at the time. Happy Souls maintained a high reputation and celebrity appeal, while Jazzy Dogs' brand reputation stayed stagnant and dropped when we lost our sponsors midway through. Happy Souls utilized retailer support from year 11 all the way into year 17, while Jazzy Dogs did not leverage its retail support, which again was a result of our decision to save costs. From analyzing our closest competitor and their strategy with the changes they made year over year compared to us from year 11 to year 17, Jazzy Dogs will be taking an offensive strategy to improve our position and market share. Over the next 2 to 3 years, Jazzy Dogs will maintain a broad differentiation strategy with the goal to lower its cost of shoe to compete with its closest competitor, Happy Souls. We will strive to offer an equally good or better product at a lower price while still maintaining our strategy. To do this, we will take an offensive approach and focus on improving our value drivers and managing how we spend our capital. Our customers will be our focus, and every decision we make will directly relate to them. We will improve in areas of style and quality by raising capital to fund higher-end materials and improve in our production modernization. This will help us ensure we maintain a high-quality shoe. Jazzy Dogs will revamp our marketing and branding strategy in all of our revenue segments, which include internet, wholesale, and the private segment. The goal of this strategy is to improve on our brand's reputation and capture a bigger share of the market. We will spend money on strategic celebrity partners to raise the appeal of our brand. Every year, we will analyze the effect our celebrity partners had on sales and determine if we should keep them or seek someone different. In our wholesale segment, Jazzy Dogs will utilize retailer support to ensure our products are in front and visible to the consumers. This will ensure we'll keep our brand's reputation high and in the minds of the consumers. Some of the lessons learned during this process is we need to invest in celebrities to increase our sales. We need to take calculated risks and not be afraid to. We need to maintain a high style and quality rating so that we could compete. Increase our investment in online advertising. Monitor our inventories year over year. Strategically cut costs to make sure that we don't affect our product. And utilize retailer support to ensure that our products are up in the front in our consumers' mind. Thank you again for taking the time to listen to our presentation.